How to use options on futures for income generation. Are you curious about how to generate income using options on futures? This topic combines the benefits of both options and futures trading, and it can be quite rewarding. Let's break down how you can use these strategies effectively. Options on futures are contracts that give you the right, but not the obligation, to buy or sell a futures contract at a specific price before it expires. This flexibility allows traders to implement various strategies for income generation. One popular method is selling options to collect premiums, especially in stable or moderately bullish markets. One effective strategy is writing covered calls on futures. This means you hold a long position in a futures contract while selling call options on that same contract. By doing this, you collect the option premium as income. If the futures price stays below the call option's strike price at expiration, the option expires worthless. You keep the premium, which boosts your returns. However, if the price rises above the strike price, you may need to deliver the futures contract at that price. While this caps your upside, you still profit from the premium and any gains up to the strike price. Another strategy is selling cash-secured puts on futures. In this case, you sell put options on futures contracts and set aside enough cash or margin to buy the futures if assigned. You collect premiums upfront, generating income. If the futures price remains above the put strike price, the puts expire worthless, and you keep the premium. But if the price falls below the strike price, you may have to buy the futures at that price, which could lead to a loss if the price drops significantly. For more advanced traders, using spread strategies can be beneficial. This includes bear call spreads or bull put spreads, where you sell one option and buy another at a different strike price. This approach limits potential losses while still allowing you to collect net premiums. If you expect low volatility, neutral strategies like short straddles or strangles can be effective. In these strategies, you sell both call and put options at or near the current futures price. You collect premiums on both sides, profiting if the futures price stays within a narrow range. However, be cautious, as this carries significant risk if the price moves sharply in either direction. When using options on futures for income, keep a few key points in mind. First, consider your market outlook. Income strategies work best in neutral to moderately bullish or range-bound markets. Second, manage your risk carefully. Selling options can expose you to large losses if the market moves against you, so ensure you have proper margin and risk controls in place. The goal is to collect option premiums as a steady income stream, benefiting from time decay as options lose value as they approach expiration. Lastly, choose futures contracts with sufficient liquidity and volatility to ensure tight bid-ask spreads and fair option premiums. In summary, options on futures can be a great way to generate income by selling options and collecting premiums. Strategies like covered calls and cash-secured puts are popular, while more complex spread and neutral strategies can also be tailored to your risk and reward preferences. Understanding market conditions and managing risk is essential for success in this area.